Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, September 18th. The Fed started cutting its interest rates yesterday while revising its growth forecast higher, and the dot plot suggested fewer rate cuts in the horizon than investors expected and penciled into the meeting. So the knee-jerk reaction from the market was quite mixed yesterday, but Asian markets rallied with joy this morning. In the UK, however, the Bank of England's decision due today will certainly not trigger the same level of enthusiasm among investors in a position to the Fed yesterday, because the Bank of England will likely keep its own interest rates unchanged today, but into a slowing UK economy and rising budget concerns there. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. And the Fed started cutting its interest rates yesterday as widely expected by a 25 basis point move, and the dot plot showed that the median expectation for the rest of this year is two more interest rate cuts of 25 basis points each and another quarter point cut in 2026. Just one more quarter point cut in 2026, but with a big disparity among members, with 6 Fed members expecting a no change, 2 expecting a hike, yes, an interest rate hike next year. I think that's going to be the members that may see scandals to be replaced. I don't know. Then 9 Fed members expecting a greater cut than just a 25 basis point cut over the course of next year, and 2 foreseeing up to a full percentage point cut next year. Voila. That's it really. The median forecast from the Fed dot plot yesterday suggests that Donald Trump won't get the deep cuts that he asked for, and the Fed is not giving in to the political pressure. And it's somehow reassuring to me. It is reassuring because, one, the Federal Reserve remains independent and it remains reasonable. It actually does reckon that the jobs gains in the US have slowed, with more than a 900,000 downside revision to the latest NFP numbers. I think it was a no-brainer, but that the unemployment rate in the United States remains low, although it has ticked up recently, while on the other hand, inflation moved up and remains somewhat elevated, they said. And the second reason why the less dovish Fed is reassuring is because the Fed doesn't see a major economic meltdown in the future that would eventually justify faster interest rate cuts. On the contrary, they revised their growth expectations for next year higher, along with the inflation expectations higher as well, as they announced their first rate cut of a series of rate cuts to come. And that, I think, is quite reassuring. But investors didn't really know what to do and how to react to the news, really. The S&P 500 first gained, then it fell, and it closed the session just 0.10% lower yesterday. Then the small cap Russell 2000 index jumped first, but erased most of the gains as the session went on and printed a shooting star formation at the end of the day. And the US 2-year yield rebounded, and the US dollar index bounced higher as well after hitting a fresh year low. Now, the direction that's going to be taken today will obviously be quite important to gauge whether the risk sentiment is still on across the global financial markets. And the good news is that US and European futures are broadly in the positive this morning at the time I'm talking here, hinting that the reasonably dovish Fed actually does keep risk investors at a sweet spot, meaning that the major US indices could continue to perform well along with global indices backed by improved earnings outlook, especially for the US companies, looser financial conditions, and also a cheaper US dollar. But the trade and geopolitical risks and tensions are never too far, mind you. Just at a time that we thought Nvidia would be out of the woods, at least in China, just because, well, they accepted to pay that 15% cut to the government on their Chinese revenues to get export licenses to China, just to find out that the Chinese, well, no longer want their companies to buy these Nvidia chips for national security reasons. And indeed, well, China went one step further than just not wanting the companies to buy, but they instructed actually companies like Alibaba and ByteDance to terminate their orders with Nvidia. And that could eventually cost the company between 300 million up to 1 billion US dollar in annual revenue loss. So no wonder the news sent Nvidia shares down by more than 2.5% yesterday and right below its 50-day moving average, and we could eventually see a deeper downside correction here before and if the narrative changes. But zooming out of Nvidia, that had quite bad news yesterday, Asian markets are quite in a good mood today, to say the least. The Fed cuts are echoing well across the region's major indices, along with a strong demand for their technology companies. So the Japanese Nikkei index rallied 1.30% today to a fresh all-time high level, regardless of the political uncertainties shaking the country. The Chinese CSI 300 index reached the highest level since March 2022, while the technology-heavy Hang Seng index shortly renewed a 4-year high, as the Korean Kospi index advanced to a fresh all-time high level as well. Elsewhere, the Bank of Canada also lowered its own interest rate by 25 basis points yesterday and helped the TSX hold ground near its all-time high levels. But today's Bank of England decision will certainly not bring the same level of enthusiasm to investors, because the Bank of England, on the contrary, will likely be keeping its own interest rates unchanged today. But faced with a slowing UK economy, political and budget concerns, and also a stubbornly high inflation in the country, with prospects of growth further slowing and inflation further rising if the next budget announcement from the UK government in fall brings more tax rises on the table. So sterling is under pressure this morning against both the US dollar and the euro, and that despite the Bank of England's cautious monetary policy stance versus a rate cut that was expected earlier this year. So this hawkish divergence because the Bank of England is no longer expected to cut the interest rates at the same speed than we did before, it's barely appetizing for traders, as it is not backed by stronger growth, on the contrary. Therefore, and if we consider that the US dollar could now print a positive correction to clear a part of this year's crowded short dollar positions, while yesterday's peak that we saw in cable could eventually be the beginning of a broader downside correction move toward the 131 to 133 range in the next 6 weeks period. And against the euro, we also expect sterling to steadily lose value. And as per the euro dollar, that 120 psychological handle, if reached, of course, could act as a solid resistance in the short run, as I actually expect the latest Fed meeting and the latest Fed decision to give some reassurance to US dollar traders that the US monetary policy and the Fed is not yet influenced by politics, and the Fed and its data-dependent approach to its monetary policy decisions remain in charge of the future of the monetary policy, and that it could be time to take profit in short dollar positions. In summary, the next 3 months could eventually see another cycle of dollar recovery, though the long-term outlook for the US dollar remains quite bearish, with the trade war going on, the geopolitical tensions and uncertainties, and also the US debt spiraling out of control that eventually lead to a global de-dollarization, and also the replacement of the US treasuries by non-sovereign assets. And I am looking at you, gold. Elsewhere, silver is down today for the third consecutive session and could eventually extend its correction in the short run, with a broadly stronger US dollar on horizon due to a less dovish Fed expectations now, and the US crude remains offered into the $65 per barrel psychological level this week, probably also a little bit pressured by a US dollar rebound, hinting that a break outside the $62 to $65 per barrel range is likely not on the menu the rest of the week, unless we see a surprise, of course. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.